Hello and welcome to Lesson 8 for Business Studies Finance. So far we've been looking at some of the processes of finance and we looked at the cash flow statement. Today we're going to look at the revenue statement and then we'll start to look at the balance sheet. This will complement the activities that you've been doing in class. So another process of financial management is the income statement. You will also know it or see it written down as a revenue statement and also a profit and loss statement. They're all the same thing. They've just been given different names. So if you see that written down in an examination or you see that on a sheet that a teacher has given you, a revenue, profit and loss, and income statement all contain the same type of information. Basically, it's a summary of all the revenue, so the money coming into the business, and all the expenses, money going out of a business in a set period of time. That is usually a year, but it can be every month. Especially in a new startup business, in the establishment phase, they may need to do a revenue statement every month so that they can manage the liquidity, cash flow, working capital a lot more tighter. It can also show you the profitability and efficiency of a business. Remember, there are two types of profit, gross and net profit, and they're both shown on the revenue statement. So here's a revenue statement that we can look at, and we can pull information from this statement. You'll see at the very top, you can see the sales, so that's the sales revenue. That's the amount of money raised from the selling of goods or services. Then we deduct from that the cost of those goods. Now that might be the inventory, so the raw materials, might be the inventory we've already got, including our purchases, and anything that we sell. So it's the cost of the goods that we sell. And importantly, cartage or delivery costs are also included in the cost of goods. Lots of people call it COGS, COGS. If we deduct the COGS from the sales revenue, that will give us a gross profit. So you can see here $360,000 revenue minus $126,000 of COGS gives us a gross profit of $234,000. Now from our gross profit we need to take away our operating expenses. Now that can be broken down into lots of different areas. The more areas that a business can break that down to, the better the business can manage each different section. So you'll be able to look over a period of time if advertising or wages, insurance or utilities were costing you too much money. In this case, it's been broken down into selling and distribution, general expenses and financial expenses, including interest paid on the loan, not the loan itself. The reason it's put here, the interest on the loan, is that can get tax deduction. So you see a combination of all those different expenses, including utilities, which is the water, electricity, gas, comes to $116,000. That is deducted from the gross profit to give you a final net profit. This is the amount that tax is paid on. The next statement that we will look at is the balance sheet. This will complement the activities you've done in class on balance sheets and components of a balance sheet. It's a snapshot of the financial position of a business. It can be at any time. It is usually done at the end of a financial year. It shows assets on one side, usually on the left side, and on the other side it shows liabilities on the right side. Included in the liabilities side of the balance sheet is owner's equity. It can show the financial stability and profitability of a business. It can tell us a snapshot of what assets, so the things that a business owns, and the liabilities, the things that a business owes, is shown at a particular time. A balance sheet is represented by the accounting equation, which is A equals L plus OE. Assets equal liabilities plus owner's equity, and the two should balance. You can also switch that around to owner's equity if you wanted to pull out the owner's equity component, must be equal to assets minus the liabilities. Whatever's left over is the owner's equity. The standard equation is A equals L plus OE, and it's very important that you remember that. Here's a balance sheet. We can look at the balance sheet. We can see that it's broken down into lots of different areas. I'll give you time to look at that and to work out exactly all the different parts of a balance sheet. The main parts being current assets, non-current assets, current liabilities, non-current liabilities, and owner's equity, which will give you a final balance. You'll see that total assets and the total liabilities and owner's equity are exactly the same at 207,300. In this case, they've shown that on one continuous sheet. Most of the time that will be shown on two sheets, one left-hand side and one on the right-hand side. It doesn't matter how it's presented as long as the two assets and liability totals balance. So let's just have a look at some of the components. The first component on a balance sheet is assets. These are the items of value in a business that can be converted into cash. They can be converted into cash in the very short term or the long term. The first current asset, which is a short-term conversion, is cash. Cash is fantastic because cash is in the bank, you can access it immediately. It is usually the savings account of the business. Another current asset is accounts receivable. That is the money that people owe to you within the next 30 days. That can be easily turned into cash. So on a balance sheet, that will be the starting of the order. The first thing that can be easily turned into cash. So usually under current assets, cash will be the first line. It's the most accessible thing. The next would be accounts receivable, because you can call and ask for your money to be sent. And the next line may be inventory. It may take you a few more days or weeks to sell the inventory, but that's readily converted into cash. The next area is non-current assets. There are usually three types to break it down. Fixed assets, large assets such as vehicles, equipment and buildings. Investments, that could be shares or bonds that have been bought by the business. And a thing called intangibles, which we haven't spoken about yet, that are things like goodwill, patents or trademarks. You can't sell a physical thing, it's a concept. Goodwill being the goodwill that customers show to you. If you sell your business, you could say to the purchaser of the business, we have 200 regular customers who maybe come in for coffee or use our services. If you buy the business, that is worth something to you. Then we can put a value on that, and that is an asset on that side of the balance sheet. On the liability side, exactly the same. Liabilities are debts, current liabilities. So this is the debts that have to be paid very quickly. And they are accounts payable. So the money that you owe to people for raw materials or goods that you have bought, usually within around 30 days. And overdrafts, short-term monthly loans on top of your normal savings account that you owe to the bank. Again, non-current liabilities are the long-term debts. These are usually loans or mortgages. Mortgages being a loan on a building or property. They will usually be paid to the bank over a long period of time. Finally, on the balance sheet, on the liabilities section of the balance sheet, you will see the owner's equity. This is usually the change of capital invested in a business over a period of time. And usually there are three elements to it. The net profit. This is the retained profit from the revenue statement that has been placed back into the business by the owners. Capital increases or capital amounts. This is the money directly invested into the business by owners. And also it will show the drawings by the owners. This money is belonging to the owners in general. So if the owners halfway through the year wanted to take some money out of their owner's equity, they're free to do that, but it must be shown on the balance sheet. If you think of the balance, the money would be taken out of the liabilities side, and it would also be taken out of the cash section on the asset side, and therefore two sides would balance. I think now, at the end of doing this very hard lesson, I think you should all get a chance to chill out a little bit and watch a Funny Zoo compilation. How cute is that?
What is he doing? Don't put your tongue on it for real, okay? That's so neat. Oh wow, he's really playing.
Enjoy the rest of your day.